Hey guys, it's Stan here. In today's video we will talk about the key financial metrics at different stages of a company. So when you Google key financial metrics, you will see that you will get a variety of results. And that's for a good reason, because it really depends on the stage of a company. I will define the different stages of the company, but you will see that if you Google financial metrics for startups or financial metrics for growing companies or financial metrics for Apple, you will see that you will get very different results. So we will walk through the different phases and then I will explain why each phase has its own financial metrics, which are more or less important depending on the phase you are in. So let's get started with the phases and then with the key performance indicators here. So here are the different phases or the different stages. It's the same for a company. First of all, there is the launch, then there is the growth, and then there is the maturity phase. Sometimes if you Google it, you will see that probably sometimes there's going to be a fourth stage, which is the decline. I'm not going to present the decline here today because the metrics of the decline and the metrics of the maturity are more or less the same, so I don't want to double count here. So we will define the different stages and then we will talk about the different metrics that match, that are relevant for the different stages here. So this is what is happening in the launch phase. It's also called the startup phase, which means usually that the founder is the owner of the newly created company. Here in this case, you are testing your business model, and especially if it's a new business model, think about Airbnb, for example, in 2009. They had no clue if some people would rent out their space and if some people would rent places somewhere at somebody they don't know. Then obviously, building customer base here, that's the key. In this phase, obviously, you have a huge risk, a very high risk, because nobody has a clue if your business model is going to work. And from a financing perspective, well, you have the owner's capital, so the founder's capital, the guy who puts his money in, plus usually you have some seed capital, which can be like the very first financing rounds you get. It's going to be a small amount of money, which is called seed capital. So now look at the 4 key financial metrics in this launch phase. First of all, there is revenue growth. We just talked about it. Obviously, you want to build a customer base, so you want to see some sales and you want to see some revenue growth from months over months. Think about Uber, for example. They started as a San Francisco company, so they tried their system in their hometown first. They were able to generate some revenue, and from there on they moved on to the next phase. So revenue growth, super important for a startup. Then obviously you have the cost per acquisition, which is also very important to understand. The cost of per acquisition, which is also called CPA, is the amount of money necessary to acquire new customers. Why is that so important? Think about it. If you're able to generate sales, that's a wonderful thing. It means that some people are interested in buying your product. The problem is obviously you have to spend some money to acquire them. And this is where it gets tricky, because if your cost per acquisition is super high, that means that you have to spend a lot of money to generate some revenues and to get some sales. That can ruin your company actually from the start, because it means basically you're burning a lot of cash at the beginning and you are running out of cash pretty quickly, which means that some investors maybe say, okay, this model's not going to work, it costs way too much money, it's never going to be profitable. So be very mindful when it comes to the CPA, the cost per acquisition. The next one is pretty much related to it, which is the churn rate, which means basically the number of clients who dropped your business. Well, as you can imagine, it's a no-brainer. It's going to be key to keep the customers that you have acquired. Obviously, if your churn rate is very high, that means that a lot of people drop your business, which means either the competition is super strong, or you're not good enough, or something in your product or service is bad. So the churn rate as an early indicator if a company can make it or not, because the churn rate obviously costs you a lot of money. The last one I would say, which is definitely important, is the working capital management. That's something obviously which is true for all phases, but especially for the first one. By the way, working capital management, if you don't know what it is, here a video in the description, a video made, it's about 20 minutes long. It's gonna explain step by step exactly what working capital is and how you can improve it. So now let's go back to the topic. Working capital management, also a very early indicator how a company is managed and if it's just livable. Now let's move on to define the growth phase. So once a company has survived the launch phase or the startup phase, it's all about growing now. It's the growing phase, and what do you need to grow? Well, you need a lot of money. Think about Airbnb or Uber in 2009, 2011, 2012, something like that. They established their business model locally and now they want to go globally. So if you want to go global, obviously you need a lot of money, which means you need new owners and or a lot of debt as well. So this is usually where the founder maybe still stays in the company and is still the CEO or something like that, but his ownership drops and other companies, especially private equity companies, come in to buy some stakes in this growth company. So here it's still privately owned, which is important. We will talk about the difference afterwards. Private equity means basically that a private fund with a lot of money invested in your business and still keeps it private. Usually the model they choose, the private equity company, is called leverage buyout, which means basically actually they bought in, so they bought shares, they are the owners of the company, and they decide to put a lot of debt on this company to use what is called leverage to finance all this growth. So basically they are charging the company with a lot of debt to have a lot of cash for growth. In this case here, in the growth phase, the long-term financing is secured. Well, first of all, through the money that the new investor, usually the private equity company, invested in the firm, first of all, and second of all, because of a huge pile of debt which they bring in as well. At this phase here, we can talk about medium risk and bankrupt because they have already a proven track record that their business model can be successful, and now it's all about scaling up, and that's why you have a medium risk here and not a high risk anymore. So now let's talk about the key financials of the growing phase here. So in my opinion, there are 5 key financial metrics you have to look at in this growing phase. 1, 2, 3, 4, 5. So let's start with the EBITDA growth. We moved a little bit away from the revenue growth and now are looking at the EBITDA growth, which is earnings before interest, taxes, depreciation and amortization, which is just a fancy term to say operating profits. So as you can see now, we are moving away from hard revenue growth and are looking at profits, right? Profits matter more and more right now. And we are also looking at the cash generation of the company, which is measured by the free cash flow. If you're struggling with EBITDA and free cash flow, I made an entire video about the different financial statements, about half an hour long. I'm gonna link it here and in this description below, which gonna explain you very well and in detail with an example, all that stuff, if you're struggling. Moving on, the next one you wanna look at is the leverage ratio. Leverage ratio is, as explained below, the debt compared to your operating profits. Why is that so important in this phase? Because you're growing, and don't forget what we are doing here. Usually the private equity company puts a lot of leverage on the company, which means they put a lot of debt on it. So here you will see that, especially at the beginning of the growing phase, the leverage is going up very strongly because you will add a lot of debt to the company and you will not see profits at the beginning, but at some point it needs to turn, because you cannot have infinite debt and not enough profit. So here the goal is obviously you want to create much more profits or faster profits than you create debt. In this formula here it's net debt, because net debt is basically the debt of the company minus the cash, because obviously with cash you can pay debt. That's why we're looking at net debt divided by the operating profit, which leads to your leverage ratio, which is very important to monitor here. The next one is also kind of similar, and also very important, is the debt to equity ratio. Again, that's the net debt, so debt minus cash divided by equity. In this case here, you are measuring, okay, I imagine I have 10 of debt and 1 of equity that my investor put in. That means that my debt to equity ratio is 10, which would be super high, which means it's a very risky company, because you have a huge debt to pay back here compared to the equity growing phase. These two will be bad at the beginning, which means they're going to be high, and then the goal is to push them down again. Next one is also very important, return on equity, short ROE. You will see that a lot of times. That's basically your net profits divided by your equity. Is it worth it for the investor to invest in this company? Let's imagine the company generated 10 of net profits and there are 100 of equity. 10 divided by 100 would be 10%, and that would 10% per year return on equity. That would be a pretty nice return on equity already. So now we have discussed 1, 2, 3, 4, 5 key financial metrics for the growth phase, and are now talking about the maturity phase. So at the maturity phase, most companies decide to become publicly listed companies, which means that they went to an IPO, which is an initial public offering. In other terms, their stock, you can buy them, for example, at Wall Street, or on the Nasdaq, or in London, or in Hong Kong, for example. So why do companies do that? Because, well, after the growth phase, usually the ownership changes. It means usually that the private equity company grew the company, and if they were successful in growing companies, so in growing EBITDA and free cash flow, they usually decide to cash out. And how do they cash out? Usually it's by an initial public offering, which means that the ownership goes from privately owned to publicly owned, which means that, for example, big hedge funds, big pension funds, or all of us can buy stocks from this company. Think, for example, about Apple or Google, these kind of companies. In this phase here, it's going to be super important to deleverage, because think about what happened here in the growth phase. You needed a lot of cash and a lot of debt to grow. But at some point, if you were successful by doing that, your profits and your cash flow also grew, which means basically that your leverage, so the debt you had, you were able to pay it back, and you are still paying it back at higher levels, which means you are deleveraging. That's very important, because if you're not able to deleverage and still have a very high amount of debt at the maturity phase, especially if you're a listed company, you're gonna be hardly punished by the investors here and by the stock market. Here, obviously, the focus shifts to the stock value and making sure the stock value goes up. Think about Amazon, for example, and the creation of dividends. You want to distribute more and more dividends. In this case, Amazon is not a good example, because the strategy of Amazon was always to focus on the stock value going up and not so much on the dividends. But there are a lot of companies, especially the big oil companies, that are focused on dividends here. Obviously, in this phase, you have a lower risk, because you have an even bigger track record of successes here. You are a very well established brand, a very well established business, so the risk is pretty low for investors, but at a high premium of it, obviously. And the growth is slowing down a little bit. It doesn't mean that growth doesn't count. Growth always counts. Think about Apple, Google, Facebook, and all these kind of huge companies, they are still measured by growth, but it's not the most important topic. Now it's all about the rest, and now we're going to look at the financial metrics for a maturity phase company. So for matured companies, I would go for these 7 financial metrics here, starting with the stock price / market capitalization. So as I mentioned before, obviously when you are a publicly listed company, when you're a matured company, let's say for example like Apple, all the investors will look at the stock price, and when you look at the stock price times the number of shares, you get the market capitalization. For example, today Apple is valued at $1.9 billion, which is their market capitalization. Next one, and you will see that if you look at a financial report, for example, from a listed company like Apple, Google, Amazon, they will also always talk about earnings per share, short EPS. What does it mean? It's basically the net profits divided by the numbers of shares. Next one is dividend yield. You will see that if you go, for example, on Yahoo Finance or something like that and type in Apple stock or something like that, they will also always mention the dividend yield, which gonna be a percentage. I just checked it for Apple. I think it was 0.75%. It changes obviously, and it tells you basically how much dividends do they pay compared to the stock price. So obviously this is super volatile, because first of all it depends on the dividend strategy, which is a long-term strategy. Usually you have some oil companies, they pay the same dividend for the last 100 years. So it's very easy to hold such a stock because you know exactly what is coming, usually. And if you compare this dividend paid to the stock price, you get the dividend yield. The stock price obviously also fluctuates. A company which is notorious, for example, for not paying dividends is Amazon. Doesn't matter, they're not paying dividends, but their stock is skyrocketing since I don't know how long, for a very long time actually. Then you have obviously the leverage ratio, as I mentioned before. In this phase you are deleveraging. So let's say if you had a leverage ratio here of 5, which means you had 5 times more debt than operating profits, then the goal obviously here is to lower that number, because less debt is usually a good sign. It means it's a less risky business, especially if it's a matured one. Then the debt to equity ratio is kind of in the same logic here. The more debt a company has compared to equity, it makes it more riskier, and if you are a riskier company, obviously you are valued probably less than if you do not have any debt, especially if you are like Apple, if you have a lot of cash on the side and if you are a very recognizable brand people love. Then you have the EBITDA margin, which kind of replaces the EBITDA growth in this case, because the EBITDA margin measures the operating profits compared to revenues. And here it's important to understand what are analysts looking at when they compare Apple to Samsung, for example, for the smartphone business. They're going to look at the EBITDA margin, and let's imagine Apple is 50% EBITDA margin, Samsung 30% EBITDA margin in the same industry. This is how they compare by using the EBITDA margins. One, free cash flow. Free cash flow is always important because it gives you an idea, is the company generating or is it burning cash? So this is always a factor to consider, especially when you're a matured company, because you should in this phase generate a lot of cash. If it's not the case, you are probably maybe declining or investing too much. So it really depends how the investors value your products for the future. So now that you know the key financial metrics at each stage of the company, I wanted to tell you that I post once a week every Sunday. So if you want to get some fresh content next week, I'm going to talk about how companies use hedging to make sure they reduce their risk to a minimum. So if you're interested in this topic, make sure to subscribe. Also make sure to like this video. If you like that content, share it with your friend. Comment in the section below if you're interested. See you soon guys, stay connected, bye bye.